MSCI is down 13% today after reporting its earnings earlier on, and if you watched today's episode, you will have noted we did say to be careful with earnings season now. A lot of companies are reporting. Now this is one that in fact is down 18% over the last 12 months, now trades at its 52-week low and is one we have added to the portfolio today. We're going to discuss why this is an incredibly strong company to add a very good compounder. We're going to run through the earnings, why in fact it is down around 13 to 14%. We're going to take a look at this company, their growing revenue top line. We'll look at their bottom line net income, as well as the standard health of the company, their total cash versus their total debt. We also want to look not just at their dividend safety, but we want to run through a lot of their financial metrics, why we like this company, a few things you do just need to consider. And as always, we'll look at both institutional ownership as well as insiders to see if they have been buying or selling. And we also want to do a deep dive on their quarter results from today. As we can see, April 23rd, this was just released a few hours ago. And as always, we're going to run it through the valuation model, what our intrinsic value was, what our acceptable buy price, what margin of safety we've used, and how much Wall Street see in terms of upside over the next 12 months. So let's start off with a high-level look at their essential earnings. What we can see is a few highlights from some key line items in their financial statements. Starting off with their operating revenue, well, they did report $680 million. Now, this is up double digits, 14.8% year over year, but we can see that analysts were expecting slightly higher, so they did miss on that operating revenue side. On their bottom line, $256 million, so up in the high single digits of 7.2%. However, again, analysts were expecting something slightly higher. And when we look at the adjusted earnings per share, what the market is interested in, they got $3.52 per share, and we can see they did, in fact, for this metric, beat the analyst estimates of $3.45, indicating a 12.1% year-on-year increase. So what we note is double-digit increase year over year, both on the operating revenue as well as that adjusted earnings per share. Now, why did this company drop significantly? And the major part for this is what we see here, the retention rate of their customers. Now, 92.8% was what they reported, which was down. In fact, we do have to admit that is fairly significant from 95.2% from the first quarter in FY23, and we'll touch upon that as well. So one of the main reasons, as we can see, for the drop, which we do believe to be a massive overreaction by the market. Free cash flow, if it's one thing you know about this channel, it is a very important metric, and we like to see that increasing year on year. Well, in fact, they increased by 13.7% to $276 million, and that is one of the things we like about this company, which we will touch upon when we look at those metrics. So let's look at the historical performance. We did mention it is at a 52-week low, and we can also say that they do offer a yield of 1.24%. The forward P is now slightly lower than this, so we can take a look on the updated metrics, and we have 1 buy rating and 2 hold. So over the last year, yes, it is down 18%, just year to date, in fact, down 21%. However, if you are a long-term shareholder, over the last 10 years, you would be up 1,145%. Bear in mind, if you were to include those dividends reinvested, it would be slightly higher. And we can see now it is continuing to fall, so this number also drops. So how about the company? They're increasing revenues, their bottom line. As always, what we'd like to see on that revenue is increasing a minimum 3 to 7% for stable companies. What we note for MSCI, $997 million in FY14. Latest annual reports, $2.5 billion. So we can see it has increased, in fact, more than 2.5 times over the last 10 years. And this is what I like to see, those increasing revenues over the longer term. How does the bottom line look? Because that is very important as well. With increasing revenues, we also want to see an increasing bottom line. Well, $284 million in FY14, $1.1 billion in FY23. So I quite like to see that as well. Very nice growth to their bottom line, although we do see some inconsistencies. 2014 to 2017, it was fairly stable, but since then it has been increasing in line with their top line. So far revenue and bottom line net income look very healthy. Then we move on to a quick health check, total cash versus total debt. 509 million of cash and short-term investments sitting on their balance sheet, 458 in their more recent year. So we know that their cash has barely moved, although over the last 10 years it has been inconsistent. Not a red flag indicator at all, but something we like to incorporate in our analysis to compare it to their total debt. Now, numerically and directionally, that total debt has increased significantly from 788 million to 4.6 billion. So that is a consideration we'll have, and we'll incorporate that in the net debt to EBITDA metric. We do know one of the things about this company is that total debt does tend to increase over the longer term, so we can analyze that information. How about some of their growth metrics? So what we want to do is just look at their grading. So they got an A-, so not that bad at all. Few breakdowns of that. Well, year-on-year revenue, 12.47%, a lot better than the sector median. When we take a look at their EBITDA growth, we can see on a forward-looking basis as well as on a year-on-year basis, double digits, with the sectors both coming in around the 9.5%. So that is very positive. And moving forwards, in terms of their earnings per share over the next 3 to 5 years, we are expecting around 12.75% increase year on year. Again, sector median around 9.95. So lots of nice metrics, as we can note here, hence why we get the A-. And when we draw your attention to the profitability, we get an A rating. So an A and A- looking very solid. Gross profit margin 82.34%, much better than the sector median. And when we look at that bottom line net income margin, 45.42%, again a lot better than the sector. Again, if you want to take a look at these metrics, you can just pause the screen, but we are looking overall very quick level, an A on that profitability as well as an A- on the growth grade. Another thing that we like to do on a total return basis is compare them versus some of their competitors. We have a few others in the financial exchanges and data industry. A lot of these are very well known. Over the last year, so this is a comparison over the last 12 months, including dividends reinvested, we do see MSCI the worst performing, down negative 17.2%, with every single other competitor. In fact, when we extend this to the last 5 years, we do see that MSCI is one of the top performing, in fact, second or third, up 110%. When we extend this and zoom out even further, significantly outperforming the rest of the competitors over 1,100%. But as always, remember, just because they performed very well over the last 10 years, there is no indication that this will be repeated again. They could perform, in fact, better. They could perform a lot worse, but just something to be aware of. We just incorporate historical performance as one element of our review. Now, institutional ownership, fairly high, 90%. We do know around 4 billion worth of sales by the institutions over the last 12 months. But we do see around 50% more buying, in fact, by the institutions over the same period. And in fact, over the more recent quarters, you have to go back quite some time before we note more selling than buying. In fact, Q3 of 2022. So institutions are buying not just in the more recent period, but also buying more than they're selling over the last 12 months. What about the insiders? Well, 3.2% insider ownership, not that small. That is fairly large for insider ownership from what we've analyzed on the channel. And we can see over the last 12 months, 1.77 million worth of sales by 2 insiders. But you would have to go all the way back to Q3 of 2023 for this sale to have taken place. So over the last 3 quarters, no insider selling. So I would say positive sign as well as institutional ownership. But as always, do your own due diligence. Don't rely on insiders and don't rely on institutions. Now, a few slides that we want to draw out from their investor presentation that this just released today. What we want to talk about is just the quarter-on-quarter movement. Now, there is essentially much better performances across the metrics. We see, as we mentioned earlier, operating revenue 14.8%, operating income 7.9%, their bottom line 7.2%, and both on a diluted and adjusted earnings per share basis, they did outperform the same quarter from the previous year. Now, we will note, however, the EBITDA margin has dropped slightly from 58.2% to 56.4%, so that is worth noting and just drawing your attention to. Now, one thing that we always like to do is look at their forward guidance, and what we can see for MSCI in terms of their revenue growth over the longer term, they are expecting low double-digit growth to their top line, which is very positive. As we do look at those metrics, you will see something that they are very, very consistent with. Their adjusted EBITDA expense growth rate, high single digit to low double digit. And when we just look at their EBITDA growth rate, low to mid-teens, with the margins in the high 50s, which is positive considering when we had a look at 2024, it was lower than the previous year. So nice signs then in terms of their long-term targets. And if they do hit this, you will note when we look at the valuation, this is incredibly undervalued. Finally, we just want to talk about why we saw such a massive drop in their share price today. In fact, 13.46%, so it does continue to drop as we do talk about it on today's episode, but it is those net new subscription rates, and we can see in every single region it has come down. We're talking 7 million in the Americas, 7 million again in EMEA, and 5 million in APAC as well. So something to bear in mind. Obviously, companies don't just drop for the sake of it. There are always reasons whether or not you believe the market is overreacting. Again, that is something you will need to come to and consider on your own, but these are just some things that we do want to point out. This company may have some challenges. As we saw, their retention rate did drop from around 95-96 to around 92-93%. Now, before we do jump into the metrics, the dividend safety as well, we just want to let you know we have released our latest free weekly article. If you want to read this, all you need to do, click on that pinned comment below. You can start reading straight away. And in our latest article, we talked about something the community keeps requesting. Where do we get all of our resources? What websites do we use? And if there are any other articles you want to read, it is all completely free. So do go ahead and click on that below. Now, metrics, let's jump in. 61 dividend safety score. It does look to be safe. Market cap, 41 billion. It is a large cap company. So when we take a look at these metrics, I will point out the things I like as well as those that I don't like. We can look from the last recession. They didn't pay any dividends, so no comparative data, but they did have plus 1.5% recession sales, which was above the average of the S&P, which was negative 12. Now, dividend growth just this year, they had a 16% increase, January 24. Over the last 5 years, on average, they've increased that dividend by 24%. So that is absolutely incredible, a very strong dividend growth company. And we can note here they have been increasing those dividends for the last 9 years. Now, let's take a look at dividend yield theory, and what it states is a company is undervalued when the current yield sits above the 5-year average. We have one massive sign of undervaluation here, with the yield being the highest on offer over the last 5 years. We have another undervaluation signal with a forward P of 30. We see over the last 5 years, on average, it has been 40.9. Now, do remember, we don't look at any of these models in isolation, and we will conclude towards the end just a few things we are pointing out, and the financial sector P is significantly lower at 11.4. How about the free cash flow payout? Very important to note, something we do focus on. Below 60%, my personal preference does give me faith that we can see those double-digit dividends we have seen from MSCI consistently over the last few years. Whilst it is increasing over the longer term, 40% next year still looks very favorable when we want to see an absolute maximum of 60. So nice to know that it has been fairly low over the last 10 years. What do I like to see when I invest in companies? One of the main things is that increasing free cash flow year on year, fairly consistent over the longer term. 1440 in FY23, expected to be around 60 in FY24. So this is a very positive sign. If you are a regular viewer, let me know below if you have seen any companies that we have reviewed that is nearly as consistent as this. It is a very strong company in terms of that free cash flow growth. And as we saw in their latest quarter, that is still continuing. Sales growth, as we took a look, steady moderate growth, 3 to 7%. What do we have here? Well, nearly double-digit increase every single year. And as we did take a look when we were looking at their long-term targets, for their revenue, they are expecting low double-digit growth. So again, this is expected to continue. And when we look at it numerically, we did look at it earlier, but just in another format, they have 2.5 times their top line over the last 10 years. If that isn't enough, well, their shares outstanding, they do share buybacks, returning excess cash to investor pockets, reducing it from 117 to just under 80 in the latest quarter. We then move on to the ROIC, return on invested capital. Now, this is important to me. I want to see 10% as a minimum. It does give me faith that management are able to effectively allocate their capital. Now, what do I love about this? Not just it's above 10% every single year, but it is increasing. 33 in FY22, 35 in FY23. This is a very positive sign of a strong company. We have increasing free cash flow per share. We have ROIC increasing, which is already very strong. And when we look at these margins, there isn't much that I can say that is negative. other than what we have talked about already with that subscription rate. We're looking at the margin operational efficiency. It is increasing, and as we saw again when we do take a look at this essential targets for the future, they are expecting high 50s, and we can see 55% was in FY23, so margins are expected to continue. Free cash flow margin, I mean, the last 6 years, we're talking in the low to mid 40s, so very strong as well. This is incredibly attractive for investors as well as potential investors. One area alongside that rate of retention that is one that I would say I would like to see a lot better is the net debt to EBITDA, the earnings before the interest, tax, depreciation, and amortization. Now, this signals both dividend safety as well as balance sheet strength. What we can see are the number of years here that it would take the company to pay off all of their debt net of cash on hand. Now, we talked about their debt. It is rising, as we saw, and 2.7, it isn't the worst in 2023. A nice sign is that it is expected to drop down to 2.43 in FY24. So there are things to consider with this company, but so far no massive red flags other than what we have discussed. Now let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, the first model is the dividend discount model. We have the yearly dividends over the last few years. Very strong growth rate at just under 19%. We've gone at 7% forward looking, and this gives an intrinsic value of $684. And as we can see, we have an undervaluation signal. But do bear in mind, we don't look at any of these models in isolation. We then move on to the discounted cash flow model, where we have the free cash flow year on year. Average growth rate 20% over the last 10 years, which is very strong, but we did see they are continuing to increase those free cash flows. We've gone for around 14%. Now, it's much lower than the average growth rate, so we do believe it to be conservative / a fair assumption. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we can see another undervaluation signal. Now, do bear in mind you can grab a copy of this valuation model by clicking on that pinned comment below to get to both the intrinsic value as well as the acceptable buy price of companies in your own portfolio or those on your watch list. So in today's episode, we are getting to an intrinsic value of $627. And margin of safety, we always start off with 10%. Now, when do we execute on that? Is if it meets 3 golden criteria. That is a wide moat, strong financial metrics, and good forward-looking data. We then keep going till it's near the current trading price, and what we can see for today's episode, MSCI does have a very large margin of safety. It isn't there at 30% just yet, but it is sitting between a 25 to 30% MOS level right now based on our estimates and judgments that we ran through today. How about Wall Street? Well, what are they expecting over the longer term, over the next 12 months? They're expecting a forecasted price of $623. They see upside of 39%. Now, we ran through the reasons why I do quite like this, why I've added this to the portfolio. We do see those free cash flows continue to increase, but again, not every company has everything going for it that's very positive. Otherwise, the share price wouldn't be declining. There is obviously risk attached whether or not they can continue with those free cash flows given that reduction in those retention rates. Now, let me know your thoughts in the comments below, whether or not this is one you're looking to add to the portfolio, whether or not, in fact, it's on the watch list, or maybe even with a 20 to 30% margin of safety and nearly 40% upside from Wall Street, there are reasons why this isn't one you will be looking to add. As always, if you've enjoyed the episode, smash that like button, hit that subscribe and bell button, let us know your thoughts below, and as always, we'll see you all on the next one.